Bitcoin mining difficulty. Nice little pink line here. What's this showing us?
Yeah, so this whole kind of slide deck is just, I've heard a lot of buzz about publicly traded Bitcoin miners. And so I think, what we really want to do here is if you're buying publicly traded miner stocks or evaluating them, how are you actually evaluating the performance? So right here we have mining difficulty, and this is in log scale. So if you look at linear scale, it's basically, it doesn't look like, it looked like it was at zero until like 2020. And then all of a sudden just went parabolic upwards. But in log scale, mining difficulty is appreciated by, I think like 10 orders of magnitude or something outrageous, as Bitcoin mining went from just doing it on CPUs where you could mine 50 Bitcoin just on your old crappy laptop to now, these just an unbelievable amount of hashing power all over the world. So understanding mining difficulty and how basically Bitcoin supply inelasticity works, where every commodity in the world, as it gets more expensive, the incentive to produce it obviously increases. But with Bitcoin, there's a difficulty adjustment. So as it gets more lucrative to produce, to mine, it becomes incrementally that much harder to get the thing. And so it's unlike any asset in the world in that sense. And I think it's really important to understand that if you're going into the business of Bitcoin mining or buying these miners.
All right, next we've got hash rate here, which also seems to just be going up along with obviously the difficulty. But is there any end in sight for hash rate?
Yeah, so essentially this is the same chart. Difficulty is basically there's a 10-minute block target over a 2016 block interval, right? So every 2016 blocks, if blocks are coming in faster than that 10-minute interval, then difficulty will adjust upwards, and likewise, if it's slower than that 10-minute target, then it'll adjust downwards. So this is showing the same chart, but hash rate is derived by basically how fast blocks are coming in relative to how difficult it is to mine blocks.
All right, mining difficulty and hash rate. When you look at this is just literally overlaying them on top of each other for the most part?
Yeah, this is just, this is in linear terms, and this is just the last 2 years, just for some, just for a visual graphic.
Okay, then we've got Hashprice, which is the miner revenue per terahash. What is this showing us?
Yeah, so this is that same chart over time, and this is in US dollars. So as Bitcoin's appreciated, a bunch similar to how hash rate has risen, but you kind of see basically, and this is in log scale, but over time, a marginal unit of hash rate gets you less and less in terms of dollars as hash rate continues to just go exponential. And so what you kind of see is that, a lot of these inefficient rigs over time have to get plugged into more and more efficient uses of that energy to stay competitive. And so it's kind of this Darwinistic process where, basically the revenue is trending to zero in Bitcoin terms. And that's what we're going to show in the next one. But this one is in USD terms. It's just pretty crazy how much hash rate continues to increase over time.
All right, then we've got Hashprice, the miner revenue per terahash in this next chart.
Yep, and so this is just an up close view of the same thing, and this is in linear terms. And so this is dollar denominated, but basically what you can see is, and if you look closely to say May of 2020, you see basically a vertical line down. That is the halving event. And so if you tend to look at a lot of publicly traded miners, basically in Bitcoin terms, what you'll see is that they trade at a multiple or pretty closely to this metric here, because hash price is taking that miner revenue and it's dividing it by the hash rate. So as hash rate increases, it basically the profit margins for a lot of these miners compress.
Got it. Then we've got more of the halvings kind of zoomed out here. You can see 3 halvings on this next graphic. And basically that's really what's helping to drive this down over time.
Yeah, so this is that same hash price metric, but it's denominating in BTC terms. So when I say things on Twitter a lot, like basically it's the production price of Bitcoin, the cost to produce a marginal Satoshi is trending towards infinity. And basically what this means is hash rates, essentially there's an economic incentive for hash rate to increase forever. If you factor in Moore's law, basically, processing power, computing power is increasing exponential terms. As well as, just there's this huge economic incentive to monetize wasted energy resources all over the world. What you see here is that along with the halvings and the difficulty adjustments, if you look very, very closely, you'll see it's like a step function all the way down in this chart. And that's every time difficulty increases or there's a halving event where you can really see it, it becomes that much more difficult to mine a unit of Bitcoin or a Satoshi. And so this is really key to evaluating publicly traded miners or Bitcoin mining in general, and we're kind of working our way in to see some of these charts in Bitcoin terms.
Okay. And then if we go ahead and we go to the next chart here, this is, I think, just a having zoomed in where you can see a very significant drop in a single one. When you look at this, what exactly is this showing in terms of on this graphic here?
Yeah, so I've kind of put a lot of similar charts in this slide deck, but really what I'm trying to show is with a mix of linear and logarithmic scale, just how fast this ecosystem is moving. So this chart is in linear terms, and what it's showing is basically how much Bitcoin a marginal unit of hash rate or a terahash can get you. So if you plug in an ASIC, what can you expect for revenue? And what you can basically see is since 2017, since the top, it's become unbelievably more difficult to mine Bitcoin, per unit of hash rate. And you can see that kind of that halving there was a decrease of 50%. And so when you look at a lot of these publicly traded mining charts in BTC terms, I think you'll notice something pretty staggering, and it might look a lot like this chart.
Got it. And then this last one here around the hash rate, this is the zoomed in on the halving drop. That's pretty significant when you zoom in on it. Is that something that we should expect every single time there's a halving?
Yeah, so this is miner revenue per terahash in BTC terms. And so what you can see here is a lot of the variance and the kind of those step functions that's difficulty and hash rate. And you can see some of the things like the miner capitulation, and with difficulty had this huge downwards adjustment. That's that spike you see kind of in July, where it actually became a lot more profitable for any miners that were able to remain plugged in. But yeah, this is in BTC terms, and every halving you can expect going forward. Eventually, fees will make up a dominant majority of the miner revenue. But for now, fees as a percent of miner revenue is still 1% to 2%, and that block subsidy currently at 6.25 every 10 minutes or every block makes up a dominant share of the miner revenue.
All right, now these next charts are going to be fun. We've got Riot denominated in BTC, Riot being the publicly traded mining organization. We have Mara, HUT, BITF, and Hive. Basically, you've got 5 of them here. What are you trying to show? And then maybe we can kind of click through each one of them as we go. But they're all down against Bitcoin. And so what exactly are you trying to show here?
Yeah, I'm not trying to discourage anybody from buying mining stocks. I have no affiliation with any of these companies. I don't really have an agenda. The charts that I was showing earlier were really trying to do one thing, and it's trying to get people to think in a Bitcoin standard. And so, a lot of these, if you look at a lot of these companies, especially over the last 2 years, or since say the bear market in 2018, in USD terms, they're up a huge amount. But especially since before the 2017 bull run, or say, at the bottom of 2020, if you're looking at a lot of these companies in BTC terms, they're down almost, some of them 90% plus. And this is because if you're evaluating these companies and their valuations in Bitcoin terms, the fact of the matter is that basically their revenue, and if they increase their hash rate, they can attempt to keep pace. But the revenue in Bitcoin terms is essentially programmed to go down forever. Basically, all minings are in Bitcoin terms. And so, playing with publicly traded miners, investing in them, allocating in them is totally fine. And I encourage people to do their own research. But at the end of the day, is a lot of this performance is somewhat expected if you kind of understand the economics of Bitcoin mining. And so the companies that kind of hyper Bitcoinize their balance sheets the best will keep up. Say Michael Saylor and MicroStrategy, since adopting a Bitcoin standard, I think are slightly underperforming Bitcoin itself, and their balance sheet is essentially 100% Bitcoin now. But a lot of these companies, they're buying a bunch of ASICs, they're trying to plug them in, and since their say IPO or just I chose 3-4 year timeframes for a lot of these companies, they're underperforming Bitcoin by a wide margin because in USD terms the revenue is increasing and they're growing fast. But in BTC terms, the revenue is decreasing, programmatically so, because of the halving and the difficulty adjustments. So these are just some things to kind of consider when you're evaluating, say, investing in mining companies or even, any company really. It's just that, the fact of the matter is it's going to get, it's programmed to become, to produce a marginal unit of Bitcoin. It's going to get harder forever if hash rate continues to increase. So, just some ideas.
Got it. And so when you think about denomination in Bitcoin, obviously denominating stocks in Bitcoin like this are pretty eye-opening. If you were to do this for the S&P 500, if you were to do this for NASDAQ, et cetera, let's say in 2021, all of them are down against Bitcoin. And that's just a function of Bitcoin was up, 65%, they weren't. And so naturally that denomination ends up looking like it's just down. Do you think that professional investors, kind of not the retail crowd, not the Bitcoin crowd, but Wall Street firms or hedge funds, big banks, like eventually do they start to change the way that they actually denominate these investments as well? Or do you think they're so kind of codified into the fiat mentality and the denomination in dollars that they stay without looking at it this way?
Yeah, I think it's pretty standard for, like, say, a lot of fund managers to get, benchmarked to the S&P or to the NASDAQ or just, to a standard basket of equities. And I think it's going to be increasingly common for a lot of these managers as Bitcoin becomes, it's already kind of entrenched itself as a macro asset. But I think, over the 2022, over the next, say 4 years or decade, really, what you're going to see is Bitcoin itself becomes a benchmark. And I don't expect the volatility to completely go away. I actually expect the volatility to persist for the most part. But I think the reality is as this asset class grows in relevance and kind of acceptance, it's going to be kind of a benchmark to say, why would I give you any money, or why would I invest in your company when I can just buy this thing and outperform, almost everything. And so whether that's for, publicly traded miners, or whether that's for hedge funds and their performance, if a simple retail investor can go buy Bitcoin and outperform you. And a lot of times with Bitcoin, not in 2021 with so much volatility, but through most of Bitcoin's history, it was the best in vol adjusted or in risk adjusted terms. It was the best performing asset as well. And so it'll be interesting to see how it all plays out. But I think Bitcoin increasingly becomes a benchmark for performance for all of Wall Street and investors in general.